Hello and welcome back. In today's video, we're going to break down a 3.5% FHA loan versus a 5% conventional loan, and also compare that to a 10% down conventional loan at 3 different credit scores. We're going to take a look at a 640 credit score, we're going to take a look at a 680 credit score, and also at a 740 credit score. Now last week I dropped a similar video where we compared an FHA 3.5% down to a 3% down conventional versus a 5% down conventional at a $350,000 purchase price. And a lot of you reached out to me and said, Jeb, my purchase price in my area is much higher. Can you show the numbers at a higher price point? So what I thought is I would take a purchase price of $750,000 and compare essentially the same 3 loan programs again, but unfortunately, once you go high balance, once you go above 548, 250 on the loan amount, you can no longer put 3% down doing a conventional loan. So in this video, like I mentioned, we're going to break a 3.5% down FHA loan versus a 5% down conventional loan, and also compare that to a 10% down conventional loan, just to give you an idea of how things change with regards to your credit score. It's going to show you how important credit score is, in addition to the down payment that you're putting down. Now, understand these numbers are coming from my mortgage broker. They're for educational purposes only. I am not a licensed mortgage broker by the NMLS. I am a real estate broker. I sell real estate. I don't do loans. So, these aren't figures that you should take and run with. You should still talk to a mortgage professional, go through the pre-approval process, and have them update you on what the interest rates are, have them go over your scenario to make sure that you fully qualify. Don't use these numbers to calculate anything, right? These are from my mortgage broker as of today, which today is the 25th of January. So you can use that as a reference point. But we're going to assume a couple of things. We're going to talk single family residence only, and we're going to use a purchase price of $750,000 like I mentioned, and we're going to go over those 3 different credit scores. Now, like I did last time, and I'll reference that other video that I did here if you're at a lower price point, if you're at that $350,000 price point and you want to have an idea of how the payments break down, check out that video. I'll also link to it in the description below so that you can pick it up there as well. But before we dive into this, I want to ask a favor. If you're new to me, new to my channel, it's all about real estate, helping buyers, helping sellers, whether it's on the buying or selling side or the finance side. So do me a favor and hit that subscribe button. And if you find the content useful, do me a favor and give me a thumbs up. So we're going to start today's video by going over the numbers. Again, we're going to start with the FHA loan at 3.5% down, and then we're going to compare it to the 5% and the 10% at that credit score, see which one actually broke down best with regards to payment, so that you have an idea. And I'm going to be looking at a paper so that I quote accurate numbers, and I'm going to throw them up here on the screen so you can take a look at them at the same time. But also understand there are some differences between FHA and conventional, which I'll link to in another video here if you want to check that out. But understand that the downside that a lot of people see with FHA is that when you put only 3.5% down, you have mortgage insurance for the life of the loan. The benefit on a conventional loan is that you don't have mortgage insurance for the life of the loan. Once you get to a certain percentage of equity in that property, you can either have the lender take that mortgage insurance off, or you can refinance out of that loan and have the mortgage insurance removed. But you can also do the same thing with FHA. So unless you're planning on keeping the same exact loan for 30 years, FHA is not necessarily a bad option, but I'm going to give you that choice. You can make that decision based on the numbers that we're going to look at. So let's dive into it and take a look first at an FHA, putting 3.5% down on a $750,000 single family home. So at a 640 credit score, that interest rate is 2.875%. The mortgage insurance is 0.85%, which gives you an effective rate of 3.725. Now, I talked about this in the other video, but the effective rate is essentially the interest rate taking the mortgage insurance, adding it on, gives you the effective rate. That's essentially what the effective rate is. So that gives you a principal and interest payment of $3,055.33. The mortgage insurance is $235.52, gives you a total payment of $3290.85. That is a principal and interest payment. There are no taxes, there are no insurance involved, homeowner's insurance, anything like that. That is just principal and interest here, so you have to also factor those in if you're using these numbers to calculate anything. So $3290 was the payment at 3.5% down using an FHA loan. 5% down, 640 credit score is a 3.5% rate. Mortgage insurance is 1.36%, gives you an effective rate of 4.86. Principal and interest payment of $3,199.44. Mortgage insurance is $384.77, gives you a total payment of $3,584.21. So roughly $200 or so higher, putting 1.5% down, putting 1.5% more down on a conventional loan versus an FHA loan. So in this case, the FHA loan is lower, 10% down. So 640 credit score, rate is 3.5. The mortgage insurance is 1%, gives you an effective rate of 4.5%. Principal and interest payment $3,031.05. Mortgage insurance $277.08. Principal interest plus mortgage insurance $3,308.13. So that is $18 higher, putting an additional 6.5% down versus the FHA loan. So the FHA loan ends up being the least expensive monthly payment when having a 640 credit score, when using 3.5% versus 5 versus 10. Now let's take a look at 680. We'll start with the FHA. Gives you a rate of 2.375%. Mortgage insurance 0.85. Effective rate 3.225. Principal and interest $2,862.10. Mortgage insurance $235.52. Principal and interest plus mortgage insurance $3,097.62. So by raising your credit score, 40 points, you saved nearly $200 on the mortgage payment there. Let's do it at 5% down. So 680 credit score gives you a rate of 3%. Mortgage insurance is 0.91. Effective rate 3.91. Principal and interest $3,003.93. Mortgage insurance is $257.45. Gives you a principal interest plus mortgage insurance of $3,261.38. So that one is what, $200 higher, less than $200 higher than just less than $200 higher than the 3.5% rate of FHA. Now 10% down with a 680 credit score is a rate of 3%. Mortgage insurance is 0.65%. Effective rate 3.65. Principal and interest $2,845.83. Mortgage insurance $180.10, gives you a principal interest mortgage insurance of $3,025.93. So in this case, the 680 credit score, 10% down, ends up being the lower option, with FHA coming in second, and now there's a difference of about $60 or so, $70 there, but you're having to put down an additional 6.5%. So does it make sense to you to put an additional 6.5% down to save $70 a month? That's what you have to decide. Now, here's where the big differences are made. 740 credit score with FHA, 3.5% down, gives you a rate of 2.375%. Mortgage insurance, again, is 0.85%. Effective rate 3.225, gives you a mortgage payment of $2,862.10. Mortgage insurance $235.52. Total payment $3,097.62. So, but on FHA, the 740 and the 680 look exactly the same. 5% down gives you a 2.75% interest rate at a 740 credit score. 0.45 is the mortgage insurance, gives you an effective rate of 3.2. Principal and interest $2,908.72. Mortgage insurance $127.31. Principal interest mortgage insurance $3,036.03. So again, you're the higher your credit score, the more money you're saving each time, and so that ends up being about $55 or so, $58 cheaper than the FHA loan, in this case the 5% down. Now 740 credit score, 10% down, a rate of 2.75, mortgage insurance 0.34, effective rate 3.09, principal and interest $2,755.63, mortgage insurance $94.21, total payment $2849.84. So in this case, you see quite a bit of a difference when putting more money down, having the higher credit score versus say the FHA loan. So again, FHA isn't all bad. So if you have a minimum down payment, you have to weigh do a cost analysis. Putting an additional, say in the case that I showed you, you save $70 a month, but you have to put an additional 6.5% down. Does that make sense? Could you do something with that additional money to make money more than that $70 per month? Those are things that you have to consider, and that's why it's crucial that you work with a professional, a mortgage professional that can guide you through the process, somebody that can put this on paper, show you your options, so you know exactly what to expect with regards to your payment. You also know your options, and that will help you in making the right decisions moving forward. And if you don't have that person and you need somebody to connect with, do me a favor, reach out to me directly. You can email me at Jeb, J-E-B, at jebsmith.net, and I will connect you to someone who can help you. You can comment in the video below, and I'll put you in touch with someone. Same goes for a real estate agent. If you're putting in an offer, make sure you're working with a professional, somebody that can help you, guide you, answer your questions, and make things happen on your behalf while giving you the right information along the way. So I hope that was helpful. I know that there are people out there that neither of these prices make any sense. I also know people out there that have lower credit scores or what have you, and want that broken down as well. But if you do me a favor, comment below. I'll try to do another video where I do that as well. But for now, I appreciate you taking the time to watch. I appreciate all the support. We'll see you again soon. Have a great day. Bye-bye.